This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 4 videos of scalping examples. I'm going to again go through some charts on how to scalp. This is the euro versus the dollar, a 5-minute chart. Throughout the day, every trader sees trades that are reasonable scalps. Most of the traders do not take most of the trades. However, in this video, I want to point out some scalps that traders have time to spot and that they can manage reasonably well. The market's in a bear trend, but the follow-through is bad. The market's repeatedly getting pullbacks. We have 3 pushes down, 1, 2, 3, and we have a good reversal up with a decent buy signal bar closing on its high. And now we have a test of that low and a reversal up, and now we have 3 bull bars, 2 of them having decent-sized bull bodies closing on their highs. This is likely to lead to at least a small second leg up, and therefore traders will buy for any reason. For example, they'll buy this close, put a stop below either this low or that low. It does not matter because they're within a pip or so of one another, betting that the worst that will happen is that the bears will get a deep pullback in a trading range. And if they do, the market will come back to this high. And the best that will happen is this could be the start of a huge bull trend. The chance of this going from this to a bear trend is probably 30% or less. A lot of traders like to scale in. If they buy this close, the worst possible price, the close of this bar right up by the high of this bar, they put their stop down here, and they'll often scale in lower. By scale in, what I mean is buy more. And when you do scale in, you usually want to enter at least the size of a scalp below your first entry. The minimum scalp size for a Forex market is 10 pips, and therefore it's reasonable if you buy here to buy more with a limit order 10 pips down, relying on your stop. If you're planning on buying more 10 pips below here, relying on your stop, you have to make sure that your entries are small enough so that a loss will be no bigger than any other loss. If a trader does buy this close and then buys more 10 pips lower, he places a limit order to get out, break even at his first entry, and then he'll have a 10 pip profit on his second entry. He does not have to exit there. Some traders will exit half there so they get out, break even on their first, and then they let their second entry go for more profit. Other traders will, depending on circumstances, let the entire trade run to see if we enter into a trend. Bear trend, bull breakout, higher or low, major trend reversal. In general, a scalper is going to get out, break even at his first entry, and then with a profit on his second entry. During most of the time, if you're trading a 5-minute Forex chart, the market's in a trading range. And if you're going to be trading as a day trader, you're mostly going to be scalping. You might be looking for a swing trade, but very often you'll see 2 or 3 scalp trades during the day while you're waiting for that swing trade to set up. And a lot of traders will simply take those scalps while waiting for their swing trades. Most traders are too slow to spot scalps as they're forming, and they end up not taking the scalps. But that's okay. Don't worry about taking every trade. Again, most traders will make most of their money from swing trades, not from scalps. They'll take occasional scalps while waiting for swing trades to develop, but don't worry about it if you don't take the scalps. Most of your money is going to come from swing trading. The market had a good breakout here. A lot of traders will look for some kind of a measured move up, and a common one is a leg 1, leg 2 move. We have leg 1, and then we have a pullback, and now we're starting to resume up. And therefore, some traders will look to take profits around a measured move up at this level. And then you never know which high the computers are using to draw channels, this high, that high, this high, or these highs. However, this is a reasonable possible top of a channel. And it's a nested wedge. This is a bigger wedge, 1, 2, 3. Does not matter if this low falls below that low, it's still 3 pushes up. And within it is a smaller wedge, 1, pullback, 2, pullback, 3. This is a nested wedge, and it therefore has a higher probability of resulting in some kind of a test down. Usually, the market tries to get to the bottom of the most recent buy climax, this low. And the market right now is very close to a leg 1, leg 2 measured move up, leg 1, pullback, leg 2. Therefore, this is a resistance area. We have a nested wedge and a measured move. And the rally is not especially strong. We have 2 good bull bars here, but then we have 7 bars without a bull bar, and then we have a small bull bar here, bear bar, small bull bar, tail, doji, bull bar, small, bear bar. This looks like a bull leg and a trading range day and not the start of a big bull trend. And if it's a bull leg and a trading range day, it'll be followed by a bear leg, and therefore we probably will not go much higher before we start to turn down. With that in mind, traders will look to sell for different reasons. One is a reversal on the breakout above this high. Traders see that if they sold this high, the market turned down below the breakout point. If they sell with a limit order at this high, it'll probably turn down. Other traders will sell with a stop on the reversal down. We have a bull breakout bar, but a bad follow-through bar, a bear body closing near its low. It's a reasonable short below that low. We have a nested wedge, and we're at a leg 1, leg 2 measured move target. We're breaking above the top of a trading range. It probably will fail. And the rally itself has had bad follow-through all the way up. It's reasonable to put your stop right above the high of this bar, 1 pip above the high of that bar, because it's a reasonable sell. Good chance of a move down here. Good chance of a 10 pip scalp. Whenever you have a small signal bar like this, a lot of traders are concerned that the market will trigger the short, go above the sell signal bar, and then turn down again. Rather than getting stopped out and selling again, they would rather use a wider stop. One way to calculate a logical location for that wider stop is a measured move based upon the height of this breakout. Therefore, some traders will sell here and put a stop above the measured move target and look to add on more, sell more higher. The minimum scalp in the Forex market is 10 pips, and that's right here. So the bears who sold here will place a limit order to get out with a 10 pip profit, which is just around the bottom of this buy climax, and that is a magnet. We also have a spike pullback channel, so the bottom of the channel is a magnet as well. This is what happened. The market quickly sold off, and the scalper who sold on a stop below that bear bar had his limit order filled right here, and he exited with his 10 pips profit. A lot of times you'll get a bounce around the bottom of the buy climax bar. Here we have 4 consecutive bear bars, 2 of them good size, closing on their lows. We're probably going to get at least a small second leg down, maybe to the bottom of the bull channel. Remember, whenever you have a bull channel, it's a bear flag, and the market usually tries to test down to the bottom of the channel. We're close to that area right now, and this might be the end of the pullback, but it's a nested wedge, 1, 2, 3, and then a smaller wedge, 1, 2, 3. We're probably going to get at least 2 legs sideways to down. 1 pullback, maybe 2, maybe a little bit more. Four consecutive bear bars, 2 with big bodies closing on their lows. That's a reasonably strong reversal. The odds are it'll result in at least a second leg down. It might result in a measured move down, maybe leg 1, pullback leg 2, or a measured move maybe based upon the height of the strong part of the bear breakout, the open of this bar, close of that bar, measured move down here. Wedge top, you expect 2 legs down. Because the odds favor a second leg down, you have to assume that means there's at least a 60% chance of a second leg down, and the first reversal up will therefore be minor and form a lower high. Traders, therefore, will be looking to sell the rally. They can sell with a limit order at the high of the prior bar. This is not a good bar for the bulls. It's a bull body, but it has a tail on top. So some traders will sell with a limit order at the high of that bar and get filled right here. And a lot of them are willing to take a quick 10 pips profit if they get it. Others will sell more 10 pips higher, betting that big up, big down means big confusion and a trading range. And a trading range means buy low, sell high. If we go high, traders will sell more. They're looking for a scalp. They sell here, they place a limit order to get out 10 pips lower. If it goes higher, they'll sell more. If it goes down to their profit target, they'll just exit with their 10 pips profit. And that's what happened here. It fell beyond 10 pips. It had to fall below 10 pips to make sure that you're filled. Sometimes it'll fall exactly 10 pips and reverse up. When that happens, your profit-taking limit order is usually not filled. It usually has to go at least a little bit below your target for the order to be filled. The bulls were hoping that we would get our double bottom with this low, rally, and maybe rally. So they were hoping that they would get a double bottom and a bounce. Instead, we got this, consecutive big bear bars, both closing below their midpoint, this one closing on its low. While it's possible this could be a failed breakout and lead to a quick reversal up, we're breaking below the bottom of a possible trading range. More likely, it's strong enough down so that we'll get at least a small second leg down. It's also possible this is a second leg trap in a trading range day. Leg 1, pullback, leg 2. Strong bull breakout, trapping traders buying high, hoping for a bull trend. And this is 2 legs down, 1, pullback, 2. Second leg strong, just like second leg strong here. It often will trap bears into selling low when in fact they're selling at the bottom of a trading range, and that second leg is a trap that will reverse. We have a wedge rally, and we're breaking below the bottom of the wedge, and we're getting a decent buy signal bar for a failed breakout below the wedge. It's a possible second leg trap, 1 pullback, 2, and a possible failed breakout below a double bottom. Usually, when you have a strong breakout like this, you're going to get a second leg down. But when the follow-through bar looks like this, and you look to the left and you see a trading range, there's a higher probability that instead of a second leg down, we're going to reverse and get to the top of the most recent sell climax. If you want, you can also call this an expanding triangle. Low, lower, lower, and then we have a series of highs. That's another reason in favor of the bulls. Again, a strong enough bear breakout to expect at least a small second leg down. Also, because it's a surprise, the bulls tried to get a double bottom. They had a good buy signal bar. They had a high 2, high 1, high 2. It is reasonable to take this buy, but instead we get this big bear breakout. Usually when you get a surprise, you get at least a small second leg down. However, you might not get more than that. Traders will look for a reversal up, either here or soon. Some bears will sell at the high of this bull bar. When a bull bar is closing on its high like this at the bottom of a trading range, even if there's a second leg down likely, a lot of traders will not take that trade. Too much risk that we're going up to the top of the most recent sell climax. However, it's a reasonable sell betting on at least a small second leg down, maybe enough for a scalp. And this is what the entry bar looks like. What does that look like to you? You're thinking, wait a minute, Al said second leg down, 1 pullback 2. Maybe that's the end of the second leg down. Also, what is this bar doing? Why does it look like that? Well, you had bears who looked at this bear breakout, betting that we'd get a small second leg down. They sold that close. How do you think they felt after they saw this bull bar closing on its high at the bottom of a trading range? Possible 2-leg trap, 1 pullback 2. A lot of the bears who sold this close they see that and they say, oh, that's not what I wanted. I wanted another bear bar. Because of that, a lot of the bears will place a limit order to get out break even right here. And that is what created this tail. Bears who sold this close, disappointed by this bull bar closing on its high, placed a limit order to get out break even here. This is less bearish than it could have been because of this bull bar. However, it's still reasonable to take that short. If it starts to go up though, you have to get out. You cannot give this much room. We know there are buyers below this bar. Disappointed bears who sold this close saw this bar. It made them disappointed, and a lot of them decided to get out break even. And that's what took place here. You have bears buying. You do not want bears buying at the bottom of a trading range if you're selling. Too much risk that the bears will only sell higher, and therefore the market has to go up to find sellers. Because of that, a lot of bulls will buy with a limit order at the low of that bar or at this close, betting that the sell the close bears will be disappointed and buy back their shorts. And if the bears are buying, you know the bulls are always buying, maybe the market will go up. The bears who did sell above this bar probably have second thoughts, selling above a strong bull bar closing on its high at the bottom of a trading range. I typically do not take that short. In general, if I see a lot of trading range price action, sell off, bad follow through, sell off, bad follow through, and we have a strong bear breakout, I expect a second leg down, but I'm not confident it'll go down far enough for a scalp. And therefore, if I get a strong bull bar here, I do not take that sell. Instead, I look to buy. With a bear bar closing on its low, a low one short, I usually do not buy it at the low of that bar. I look to buy with a stop above the high of this bar. Trading range, a second reversal up at the bottom of the range. First reversal failed, and then second reversal. But just like it's reasonable to sell at the high of this bar with a limit order, it's reasonable to buy at the low of that bar. My preference in general in a situation like this, where things are confusing, is to take a stop entry buy or second entry buy. First entry here, second entry there. I want to buy low and sell high. This is low in a trading range. I want to buy low. This is a buy zone for me. The bulls who bought below this bar right now are feeling pretty good. The bulls who instead placed a stop order to buy just above the high of that bar would have been filled right here. The target always is the top of the most recent sell climax, this high. And you also have another target, the moving average. The reason this bar looks like this is the bears are giving up. They sold this close. Other bears sold the low one, a bad entry bar. They can see it reversing up at that low close. They know the sell the close bears here are buying back their shorts. And now we have a bull bar closing on its high. This represents a lot of bears panicked that they sold the low and they're buying back their shorts. This is a give up bar. The bears are giving up. This is what I was talking about. I typically do not take that sell, a good bull bar after a bear breakout, even though it's a surprise bear breakout. It's at the bottom of a trading range. I'd rather take a second entry buy because the second leg down is likely. The second leg down is small, and they bought that low close. This is a good stop entry buy. I don't like taking the first sell below a bear bar after a breakout, especially once you have a reversal up like this. I'm willing to take a second short, low one, pullback, low two, but I usually do not take the first entry short. I sometimes take this buy. This is a higher probability buy. A second reversal, bottom of a trading range. This is where I typically would enter or take this buy, not that sell, not this buy. You'd expect at least two legs up. The bears are buying back their shorts. This is one, pullback two. Also, you know a lot of the bears have stops above the top of this sell climax, and that therefore is a magnet. Right now, at this moment, there's a 60% chance we're going to get up to the high of this bar. And the rally is not all that strong, but look how this low did not fall below that bar. This low did not fall below that bar. The bears were unable to trigger the low 2. Low 1 pullback. They could not trigger the low 2. The bulls who bought here have no reason to get out until up here. They might get out below this bull bar. They probably would get out below that bear bar if they did not already scalp out at this high. To me, this is a reasonable target as long as you can exit with a 10 pip profit. Had you bought here, this is 10 pips above there. You could therefore exit with a limit order. And it's a reasonable place to exit. Sometimes the reversal does not quite get above the high of this bar, but you're still selling right near its high. That's a reasonable place for the bulls to scalp out with a 10 pips profit. Three pushes up, 1 pullback, 2 pullback, 3. So it's a wedge top, and it's a double top. A double top with this high, slightly higher, but still a double top. It's possible that this is an endless bear channel. We have a new low, a lower high, a new low, lower high, new low, lower high, and we keep channeling down. However, we have a lot of bull bars here, and several of them closing at or near their highs. More likely than an ongoing bear trend, this is probably going to be the bottom of a trading range, and we'll probably have a hard time falling much below this area. For the bears, they have a bear trend and a pullback to around this high. They see this as a double top bear flag. Bear trend, a pullback to a prior high here. Some computers will say the double top is this high and that high. A double top at the top of a sell climax, usually you get some sellers here. You get bears selling with a limit order at that high, betting that the bulls will take profits, and you have bulls selling as well. They were looking for a test of the top of the sell climax, so they sell as well. And therefore, this could be a double top bear flag. We could break below the neckline of the double top and fall for a measured move down. Bears will therefore sell. We have a wedge, 1, 2, 3, a double top, and a trading range. We're around the middle of the range. In general, I prefer to sell higher, but it's possible that we turn down here, we turn down here, maybe we'll turn down here as well. While a bear could sell on a stop below that bull bar for the double top and the wedge rally, it's usually better if you're selling with a stop to sell below a bear bar. So this would be a logical location to sell, looking for a couple legs down, maybe 1 pullback, 2. Maybe it'll go far enough down for a 10 pip scalp. If you do sell below that bear bar, you place a limit order to buy back your shorts 10 pips down. This fell a little bit below 10 pips, and that means you would have been able to scalp out with a 10 pip profit. This low is actually 11 pips below that low. Therefore, in fact, most bears would not have been filled. If they sell on a stop below this bear bar, this low is 11 pips below the sell signal bar low. You enter 1 pip below the sell signal bar, and therefore this low is 10 pips below your entry price. Probably most bears who sold below that bear bar with a limit order to buy 10 pips lower did not get filled. Usually if the market goes right to your limit order and reverses up, you do not get filled. Therefore, most of the bear scalpers who sold here, the market touched their limit order but did not fill their order. They will then look to get out on a reversal up if it does not get filled pretty quickly. The bears who took the first sell below the low of this bar, the bull body, were able to get filled. This low is 12 pips below that low. They get short 1 pip below here. It falls 11 more pips. Their 10 pip order to buy back their shorts would have been filled. But the bears who sold below the bear bar probably did not get filled. The bears who sold here will look to exit on some kind of a reversal up. For example, they might get out above this bear bar. They might get out above this bull bar. They might get out on the follow-through bar after this bull bar, or above the high of this bar, above the high of the prior bar. Once you had this bull breakout, a lot of the bears will look to get out above the high of the prior bar, and they would have been out above the high here. In any case, if you sold here looking for a scalp, it hit your limit order and now is reversing up, traders will get out. They don't want the market to come back to their entry price up here. The entire height of this range is about 40 pips or so, which is relatively small. A lot of times the market will be in a 30 or 40 pip range, and when that's the case, it's usually easier to make money entering with limit orders using wide stops and scaling in instead of entering with stop orders. And that's what a lot of scalpers will do. It's okay to take stop entries, especially at the bottom of the range. For example, a second entry. When we went down, reversed up, reversing up a second time, this is a reasonable stop. Here, we're likely to get a second leg up, bull breakout, and now we get a double bottom bull flag. That would be a stop entry buy. Here, it's a wedge, 1, 2, 3, a bull bar reversing, a third bull bar reversing, okay to buy above the high of this bar. It's a third entry buy, 1, 2, and then 3. And when you're near the top of the range, bears will look to sell. If there's a good sell signal bar and a reasonable reason to sell, they'll sell with a stop. Here we have a nested wedge and a reversal with a decent sell signal bar. They'll sell with a stop there. And they'll especially take the first entries if they can use a wide stop and scale in. Again, the euro versus the dollar, a 5-minute chart. This is a common problem. Traders see the chart breaking out repeatedly, a bull breakout, bear breakout, bull breakout, bear breakout, and they think that it's a trend that just keeps reversing. And they're in denial. It's a trading range. Every time a trader sells at a prior high, he makes money. Every time he buys at a prior low, he makes money. To bet that the breakouts will be successful is a losing bet. It's more likely that you'll make money buying below lows and scale in lower, selling at prior highs and scaling in higher. And to deny that it's in a trading range because all you look at is the 3-bar bull breakout, the 4-bar bear breakout, you're going to lose money. You have to look at all the bars to the left and understand what the market is doing. It keeps testing prior lows and prior highs and reversing. If you deny the reality that's in front of you, you'll lose money and you'll keep trying to buy high and sell low. And that's the exact opposite of what profitable traders are doing. A beginner knows that this is a trading range, but he's so hopeful that the market will soon break into a trend. He waits until he's certain the trend has begun and he ends up buying up here. Or he waits until he's certain the bear trend has begun, 4 consecutive bear bars, and he sells here. He refuses to look to the left and see that this is simply testing the bottom of the range and this is simply testing the top of the range. They know when the market has lots of reversals and is mostly sideways, it's better to buy low and sell high and scalp. Yet beginners constantly are hopeful that the trading range is going to break into a trend, and as soon as they see some strength, they're convinced this is the start of a trend. They buy high, they buy high, they sell low, they sell low, they buy high. And that's the exact opposite of what you have to do to trade when you have a lot of trading range price action. Just look to the left. When you see a big breakout like this, look to the left. What do you see? A trading range. Chances are this is a bull leg in a trading range and not the start of another bull trend. Just look. If you're buying a breakout of a prior high, if you buy at that high, if you buy at this high, if you buy a high 1 bull flag at the top of this double top, if you buy this breakout, look what happens every time you buy high, Every time you buy high, you're losing money. And the beginners keep selling at the bottom, hoping that the bear breakout attempt is going to turn into a bear trend. Remember my 80% rule. When the market's in a trading range, 80% of breakout attempts, up or down, no matter how strong they are, will fail. Much better in a trading range to buy low instead of sell low, and to sell high on a bull breakout, betting the breakouts will fail. Experienced traders, they know it's a trading range, and although it seems stupid to sell strong bull bars and buy strong bear bars, my 80% rule says it's very logical. That's how to make money. I gave more examples about Forex scalping. In general, if the market's in a trading range, it's better to look to buy low, sell high, and scalp than to bet strong breakouts will have follow through. 80% of the time, they will reverse. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on scalping.